Alright, so I'm going to run through a higher level example on the final accounts of a sole trader that you've been doing. The example I'm going to go through is on page 104 in your book. Compared to the ordinary level questions, trial balance pretty much going to be the same. Maybe we'll see one or two new things we haven't seen before, but broadly the same. The profit and loss on the balance sheet, the same. Okay. What is different here is the adjustments are a step up in difficulty. Some of them in particular will have quite a few moving parts, and will take a while. But like the ordinary level questions, you see the same stuff coming up question after question, year after year. So though some of these might seem kind of quite difficult on first glance, you'll be doing kind of similar stuff over and over again and will kind of get the hang of it. And most of them are, you know, a lot of them are kind of straightforward once you've practiced them. Some of them will always kind of, as I say, have a few different bits to them and will be tricky. I'll just run through the trial balance very quickly, just maybe highlighting anything new. The investments here with the percentage attached to them, I don't think we've seen before. So investments from the 1st of June. So we've seen that kind of thing with loans before, where we don't have them for the full year. Are worth 150 grand, and they've got this percentage attached to them. Basically, that means we get 12% of 150,000 per year as income. Okay, because it's kind of like the mirror image of a loan. All right, so rather than being charged that percentage as interest on the loan, we're getting 12% of the 150,000 as investment income every year. 9% fixed mortgage, including an increase of 40,000 on the 1st of April. So we've seen mortgage before. That's going to be long-term liabilities down at the bottom of financed by. What we've seen before is maybe only getting the mortgage halfway through the year. What's happening here is the mortgage is increasing during the year. So you had 160 at the start of the year, and then took out another 40,000, and then it's 200,000 that you have borrowed at the end of the year. Investments will be a financial asset, by the way. Patents, then, an intangible asset we've seen before. We haven't seen this incorporating 4 months of investment income. So some of the income from the investments is put in with patents by mistake. They'll tell us to deal with that in an adjustment down here. Discount net just means rather than putting in discount received and discount allowed, they've subtracted them from each other and just put one number in. Suspense, then, so insurance includes suspense. Suspense is basically if the person kind of preparing these accounts, so you know, during the year, people have made entries in the accounts for everything that's happened. So every time you sell something, every time you buy something, and then it's summarized here at the end of the year. So at some point during the year, when someone was preparing the accounts, they weren't too sure of one of the entries. So let's say they knew they had to credit sales for something, but they weren't sure of the debit entry to go with it, for example. Then they put it in as suspense. So suspense is basically, I'm not sure what the other half of this transaction is, how I should put it in the accounts. So I'm going to put this suspense number in just to make the accounts balance, and then someone will kind of review it and look at it and kind of sort it out at the end of the year. All right, so suspense is kind of a, you know, not sure what to do. It's like a placeholder there, and then we're going to be told something in an adjustment down here that lets us basically get rid of it and put the stuff in the appropriate place in the accounts. Nothing else there is new to us then. All right. So as I said, it's onto these adjustments, which are the bit which kind of differentiates these from the ordinary level ones. They are going to be a bit trickier. Where they're kind of dealt with adjustment by adjustment at a time, telling you what to do with them in the book, is page 163 to 175. So in with a different final accounts chapter. So if you're looking kind of for a bit more explanation, kind of written, so aside from this video where I'm going to talk through them, page 163 to 175 in the book is where to go. All right, so on to my adjustments then down the bottom. So stock at the 31st of December at cost was €51,000. This includes damaged stock which cost 5,000 but which now has a net realizable value of 3,500. So that stock of 51,000 is our closing stock, and it goes in current assets and it goes in cost of sales. What they are telling us here is this includes 5,000 which got damaged in some way. So now we're only going to be able to sell it for 3,500. So it doesn't really give what we would call a true and fair view of the accounts of the company if you put that stock in the accounts at €5,000. Okay, so you should reduce this down to 3,500 because that's what it's worth now. Okay, so what we're going to do is we're going to take the 5,000 out and put the 3,500 in. Okay, or basically adjusted by the difference between them. Okay, so the idea here is that stock is always valued in the accounts at the lower of cost and net realizable value. Okay, so if it gets damaged and the net realizable value is lower than the cost, you're going to need to adjust the cost, bring it down to the net realizable value. All right, so working one here. Closing stock €51,000. Take away the 5,000 for damaged stock plus the 3,500 for what it's now worth, and that is 49,500. All right, so the difference between them is 1,500, so I'm essentially taking the 1,500 away, adjusting for that. All right, what you find in these higher level questions as well is you might be returning to this again and maybe adding or subtracting something else from closing stock. I don't know if we have that yet. So before I go into working two, I'm going to leave a couple of spaces just in case I need to return to this and adjust it again. Okay, or maybe leave a bit of space over here to maybe do it, something like that. So the order level questions, you find the adjustments are discrete. So you will have an adjustment to closing stock, and that's it. That's your closing stock figure. Your next working, you'll have an adjustment to purchases. That's it. Your next one, you'll have an adjustment to debtors, and that's it. With these ones, maybe work like A and D might both refer to closing stock, so you might be kind of returning to this and adjusting closing stock. And I think the better idea is leave working one as your closing stock working, and if something comes up later that adjusts closing stock, come back here and make the adjustment here, rather than kind of having kind of closing stock adjustments all over the place. All right, that's a standard enough one, and that's kind of once you've seen that adjustment, it's straightforward enough. The next one then is something which has, as I say, a good few moving parts, as I mentioned before. So provide for depreciation on vans at the annual rate of 15% of cost from the date of purchase to the date of sale. Note, on 31st of March, a van which cost 16,000 in 2015 was traded in against a new van which cost 20,000. An allowance of 7,000 was made on the old van. The check for the net amount of this transaction was incorrectly treated as the purchase of trading stock. This was the only entry in the books in respect of this transaction. Okay. So, there's a few things I need to do here. The first and maybe easiest thing to do is the check for the net amount of this transaction was incorrectly treated as purchase of trading stock. So we've got something in purchases which shouldn't be there. So we're going to need to adjust purchases. We've sold a van. We've sold one of our fixed assets. We will have either made a profit or a loss on that sale. And that profit or loss needs to go in our profit and loss account. Okay, so calculating the profit or loss is going to be like the second part of this adjustment. And the third part then will be dealing with the depreciation. So calculating this year's depreciation with the complication that for 3 months of the year we'd something that cost 16, and for 9 months of the year we'd something that cost 20 in there, so it won't be the same amount of depreciation for the full 12 months. And with also the thing that we sold, the van that we sold, that will have accumulated depreciation sitting in the accounts, and we're going to have to remove that. Okay, so a few parts there. As I said, the first one, the most straightforward one, is the purchases. So let's deal with that. So working 2. So purchases in the accounts is 505,000. And then the check for the net amount. So the new van cost 20,000 and we got a trade-in of 7,000 on our old van. So we only paid 13,000 for this van. Okay, so the thing cost 20 grand, but they gave us a 7,000 euro trade-in on the van we're getting rid of. So 13,000 euro was put into purchases incorrectly. Okay, because it's a fixed asset. Okay, it shouldn't go into purchases. So take away 13,000 from purchases, and 505 take away 13,000 would be 492,000. Okay, and they tell me that's the only thing which went into the accounts for this. So everything else I'm going to be putting in from scratch. Again, I'm going to leave a few. I think I saw something about goods in transit. There is going to be something else you're going to be adding or subtracting from purchases. So what I'm going to do is leave a couple of lines for that and go on and do working 3. And I need to work out the profit or loss on the van. Okay. So I got rid of a van that cost 16,000 euro. So that's going to be my starting point. So cost of van, 16,000 euro. But if I bought that van in 2015, it's not worth 16,000 in my accounts because I've been depreciating it for about 4 years. Okay, so if you're calculating the profit on the van, you shouldn't be how much you got for it less the 16,000. You should be comparing what you got for it to the value of it in your accounts. Okay, so what you're going to need to do is figure out how much has that van been depreciated since May 15, basically finding the net book value of just that van. Okay, as we can see here, like the vans cost 90 grand in the accounts, but they're sitting there as 55,000. So that's 35,000 accumulated depreciation. Some of that accumulated depreciation is on my van. All right, so they tell me that they're depreciated at 15%. So vans are depreciated at 15%. So 16,000 by 15% is 2,400. So that's 1 year's depreciation. And then if you look at it, I'm getting rid of it in March 19. I bought it in May 15. So I'm going to have some full years of depreciation, but I'm also going to have some like odd months of depreciation as well. So let's just figure out what 1 month of depreciation is as well. So if a year's depreciation is 2,400 divided by 12, and 200 euro is a month of depreciation. So you bought this thing in May 15. So 16, 17, 18. You have 3 full years of depreciation anyway. So 16 to 18 depreciation is 2,400 per year by 3 years. So that's 7,200. In 2015, I bought it at the end of May. So that's 7 months of the year you had it for. So you're going to have 7 months of depreciation in 2015. So 200 euro by 7 is 1,400 euro. And then in 19, I got rid of it at the end of March. So that's 3 months depreciation. So 3 200s are 600. And I could put in the 3 by 200, the 7 by 200, the 3 by 2400 here as more workings if I wanted. Add the three of those, and that is 9,200. So that's how much you have depreciated the van by before you disposed of it. All right, you traded it in. So I'm going to take that away from the cost of the van. And 16,000 take away 9,200 is 6,800. So that's the net book value of the van you disposed. Okay, how much did you get for the van then? So I got an allowance of 7,000. Okay, so that's like what I sold the van for, 7,000. I got a trade in of 7,000 on it. So trade in or allowance, you're going to subtract those from each other. 7,000 take away the 6,800 is a €200 profit on disposal, because you traded it in for 7,000, but in the accounts we said it was only worth 6,800. Okay, so that is profit on disposal, €200. Okay, so that €200 is going to go into your trading profit and loss account. It's going to be other income. Okay, so that's other income on your P&L. All right. The other adjustment then I need to make here is, so accumulated depreciation of 9,200. So that will be sitting on your balance sheet as accumulated depreciation on the van. But you don't own that van anymore, so you should get rid of that 9,200 out of accumulated depreciation. Okay, so that's going to be subtracted from accumulated depreciation on the balance sheet. Okay, you don't own the van anymore, so you shouldn't include the accumulated depreciation in your accounts anymore. You're going to get rid of the 16,000 out of the accounts, the cost of it, you're going to get rid of the accumulated depreciation, and then you're recognising the profit then on the disposal. The other adjustment that I need to make for this is just figuring out how much the depreciation is going to be for this year. So that will be working for. And it tells me that provide for depreciation on vans at the annual rate of 15% of cost from the date of purchase to the date of sale. So delivery vans cost 90,000. That's what's sitting there at the start of the year. Okay, it's at the end of March 19 then that I sell something or trade something in and purchase something new. Okay, so for the first 3 months of the year, it's 90 grand that I'm going to be depreciating. So let's do that. Okay, so first 3 months of the year, so 90,000 multiplied by 15%. So 90,000 by 15% is 13,500. So that's what depreciation would be for the year, but I only have that cost of vans for 3 months before I trade something in and sell something. So let's just get 3/12 of that, and that's 3,375. Okay, the other 9 months of the year then, so we vans cost 90 grand, we get rid of one costing 16, and we buy one that costs 20. So you're going to take the 16 out, so you trade it in, and add the 20,000 on. Alright, so that'll be 94,000. And then get 15% of that, whatever, if that's equal to whatever it is, and then get 9/12 of that, because that's your depreciation then from the 1st of April. Alright, so if you work all that out, you get 10,575. And if you add the two of those, you get 13,950. All right. So that is your depreciation for 2019. So that's going to go in your selling and distribution expenses as depreciation. Selling and distribution because it's delivery vans. And then it's also going to be added on to accumulated depreciation in the balance sheet. Okay, and then just be aware of this. Okay, so for the accumulated depreciation in the balance sheet, you're going to add on a 13,950 as 2019's depreciation, but you're also going to subtract 9,200 as the depreciation on the disposal. Okay, Grant, I will continue on then in another video.